is slightly different to the one whereby the parent is selling to the subsidiary, because it will be more effect on the analysis of the shareholders, because we'll be dealing with the subsidiary part. So I don't know if you want me to start with the summary first, or can I tackle the question? Can I tackle the example and do the summary after? You tell me which way you prefer. I'll start with you, Mudise.
Okay, I don't know, but anything as long as Tendek is happy with it.
Okay.
So,
Uh, let's do the summary first, and then we'll tackle the thing. We'll tackle the example on the slide guide. So normally, when the subsidiary is selling to the, okay, hold on. Let me share my thing. I forgot to share. Let me share my Excel and tell me when you see it. Are you seeing my Excel? The subsidiary selling depreciable item to parent.
yes.
Yes, we said.
Okay, now let's continue. So the summary here, first, we're gonna have that unrealized profit thing, or we're gonna have the cost. So we're gonna have that profit which is realized or unrealized based on the situation, because if the profit was for something which they bought it or that was purchased last year and they was sold also last year, so on the last year it will be unrealized profit, and then on the current year it will be a realized profit. But for the depreciable part, we only realized the profit on bit by bit, so it will be more realized based on the percentage of the depreciation of that particular asset. So unrealized profit will be realized and during the following subsequent years. Yes, according to depreciation model. So the treatment of this unrealized profit in the current year. First, we're gonna have this unrealized profit is gonna be deducted from the cost of assets. So unrealized profit will affect the face value of SFP. SFP meaning for statement of financial position. SFP on the cost of an asset, which in this case you're gonna have to deduct it. You deduct, and then two, the depreciation on profit, which you're gonna have. Let's say in this case you have the unrealized profit of 5,000. It's the unrealized profit, and they tells you that depreciation is regarded as 10% annum. Depreciation is 10% PA. Now, it means when you will be realizing this depreciation, the realization part of this profit will be 500, which it will come as a result of 5,000 times 10% then for the whole year. So it means we're going to only realize the 500 as part of our profit in the subsequent year. So this will be done in the following year. And on the following year, when you do that, let's see, it's gonna be deducted from the accumulated depreciation, this thing. So 2 will say the realized profit, the realized depreciation on profit. Let me put it that way. Realized depreciation and on profit will affect the face value of SFP on the accumulated depreciation. And in this case, it will be a deduction, this one. So this one, it was we deducted this part. Let me highlight it. And then 3. Now, on the current year, on your statement of profit and loss. So 3 will be the depreciation on the statement of profit and loss. Treatment. Depreciation in SPL, which is statement of profit and loss. You're gonna deduct the current year depreciation from the profit. So the realized depreciation on profit, which it will be our number 3. Realized profit, or the realized depreciation on profit. Realized depreciation on profit will be deducted from the admin expenses in the face value of SPL. Then 4, it will be the effect on the analysis of shareholders. The effect on the analysis of shareholders on the subsidiary part. So this in the analysis of shareholders will be treated as follows. 1, the profit which occurred during, like the profit occurred is either in the since acquisition or in the current year, depending on the date, it will be deducted. And again, you can add the depreciation on the profit realized based on the year it occurred, which this one it will be more on the prior year. So if you sold the asset last year for 5 and you made a profit of 5,000, and then they tell us that this asset must be depreciated by the 10%. So it means the 500 for last year, it will be deducted. But the 500 for last year will be deducted in the last year financial year. But when we'll be doing the 2021 financial year, it means that 500, which was unrealized profit last year, now it's gonna be added back on our statement of profit and loss in our profit, and then we deduct the one for the current year because it will be the one for the unrealized profit, not yet accounted for the following year. So it will be like this on the analysis of shareholders based on either the current or since acquisition up to the beginning of the current year. That one, it will depend more on the date. So when we be doing one of the examples, you will see how does this have an impact. So we'll say based on the date, which it can be since acquisition to beginning of current year, or it can be straight current year. The profit will be deducted if it occurred in, let's say if it occurred in the current year or on the current year which it occurred, the profit will be deducted on the current year it occurred. Current year it occurred. And another thing, we're gonna add the depreciation, add depreciation on profit realized. Based on the year which it occurred. So in our case, it will be last year realization. So since we have a profit of 5,000, and then we said our depreciation is 500. So our 500 of the last year will now be added in the current year. Then, oh gosh, let me. Okay. Then let's see our example on. Let's see our example on page 137. No, not 187. Should be 144. On page 144, we've got the subsidiary selling the depreciable asset to the parent, whereby our subsidiary is Y and our parent is X. And then we've got the pre-adjustment trial balance. And then we've got the statement of changes in equity. And then the lastly is the adjustment based on what was happening in their books. So when we go to our adjustment, they tell us that X Limited acquired its interest in Y Limited on 1 January 2006, on which date Y Limited retained earnings amount to 6,000, and you can consider the carry amount of the assets and the liabilities of Y Limited to be equal to the fair value thereof on the date of acquisition. Then on 1 January 2008, which is the last year, because our year is ending on 30 June 2009, which started on 1 July. So based on the prior year, X purchased all its machinery from Y Limited at a cost plus 25%. So it means the profit will be calculated at cost times 25 divided by 125. Then both companies, they write off their depreciation on machinery at 20% per annum according to the straight line method. So since they say on 1 January 2008, X purchased all machinery from Y, so the cost price of the machinery of X is sitting on the 14,000. So it means the profit will be calculated from the 14,000, which it will be the 14,000 times 25 divided by 125, which will realize a profit of 2,800. Then now let's see how we're going to tackle this. We're going to start with our analysis of shareholders. So when we go to our analysis of shareholders, it's going to be the same setup that we used to. So our books is, who's this guy? Y Limited is our subsidiary. Then we're gonna have the at acquisition part, the current, the total, at and since. So we've got at acquisition, and then we've got the total. We have at, and then we have since, and then we have NCI. So on the date which they acquire, the share capital of X as presented in the thingy, in the pre-adjustment trial balance. Share capital, it's sitting on total of 20,000. And we told that he shares that were issued is 20,000 and he acquired 15,000. So we say the 15 divided by 20, which I think it should be 75 somewhere there. Yeah, it's 75. So times point, okay, 20 times 75. Then we have 11,250. I mean, we have 15,000, sorry. 20 times 0.75, 15 on the at, and then the NCI will be 5. Then we go further. The retained earnings as given from our pre-adjustment trial balance is 6,000. Retained earnings of 6,000, and we do our percentage, which would give us the 4.5 and the difference of 1.5. So the consideration, we're gonna do the total, which they will give us the 19,500. The consideration given as shown in the pre-adjustment trial balance is also 19,500. So it means the goodwill will be nil, 0, and here we have a total of 19,500. Then we go further. We do our since acquisition. So in this case, it's gonna be since acquisition to the beginning of the current year, because the acquisition was done on acquisition was on 1 as per thing 1 January 2006. 20.6, and the fine, so it means it will run from 1 January 101, or I will say to run from 101 20.6 to 30.06 20.6, and then the other year it will run from 107 20.6 to 30 June 2008, 30.06 20.8, And then our current year will run from 1.06 07, sorry, 07 20.8 to 30.06 29. So this will be current. This part will fall under since acquisition to beginning. And then this one will also fall under the since acquisition to the beginning. And then who said it doesn't have access to Glen Rose? Glen Rose. Can you speak, Glen Rose, or just type so that we can hear what is your story? If your mic is having a problem, just type so that I can assist you. Let's continue in the meantime. My since acquisition to the beginning, the 1 July 2006 to 1 January 2006 to 30 June 2006 will be my since acquisition also to the beginning of the current year. So this will be the current, and then these two will fall under the since acquisition to the beginning. Now let's continue with our part since acquisition to beginning of the current year. So anything that happened between the period of 1 January 2006 after the acquisition to the 30 June 2006 must fall here. So our trade, our acquisition, our purchases of the machinery, it happened on 1 January 2008. So it means it's somewhere in the, it falls somewhere here in this category. So it means it's going to fall under the since acquisition to the beginning of the current year. So we have to go to the profit which they made. How much was the profit made on that transaction? So first, let's tackle the retained earnings part. So we're going to have a balance on the retained earnings, the normal one we used to calculate. So we deduct the retained earnings from our balance at the beginning versus the retained earnings, the one which was on the at acquisition. So as per the information here, the retained earnings at the beginning of the year for Y, it was 9,000 from the statement of changes in equity. Retained earnings, $9,000 as the balance at the beginning, less the one at acquisition. So at acquisition, we were told that the retained earnings, it was 6,000. Then it means here we're gonna have a total of 3,000. However, okay, so which we will say is 3,000. Then on the 3,000 we have, there was a profit because the asset was purchased on 1 January 2008, which the profit they made of the profit will be based on the 14,000 times 25 divided by 125. 14,000 times 25 divided by 125. The 2,800 is the profit. So this 2,800 profit affected our retained earnings in the prior year. It increased the profit in the prior year. But now, because it's not yet realized, it's the unrealized profit. But the realization can happen either through selling of the outside parties or through the use of that particular asset. So now we have to deduct that 2,800 here because it affected the profit in the prior year. So we minus the 2,800. So it means now our retained earnings for the since acquisition, it will sit on the 3,000 less 2,800. So it's gonna be, it's now sitting on the 200, which it will be the 200. But question is, there was a certain portion which was now realized on the depreciation for the 6 months. The 6 months that we are talking about, it will be the one from 1 January 2008 to 30 June 2008. Because remember, the balance that we are dealing with, the retained earnings at the beginning of the current year, is the one starting from 1 July 2008 up to, I mean, the one starting from, the financial year started on the 1 July 2007 up to 30 June 2008. And the one started from the 1 June 2008 to 30 June 2009 is the current year. So we want the balance as at on 1 January, on 1 July 2008, which comes from the prior year financial year. So on the prior year financial year, we had the 6 months whereby the asset was being used because he purchased the asset on 1 January 2008, but between 1 January 2008 to 30 June 2008, AX Limited as the parent, he was using that asset. So it means the asset depreciated. So now we have to add that depreciation because we are now realizing it. So it means we're gonna say now we add the depreciation on the asset. So the depreciation on the asset, let's calculate it. Calculation of the depreciation. So first we calculate the profit. Profit will be the asset which was purchased on 1 January 2008 is 14,000. The total cost of the asset is 14,000. Then you multiply by 25, you divide by 125. Then you get a profit of how much? 2,800. This is the profit. Now the depreciation on profit. Depreciation on profit. You're gonna have period 101 20.8 up to 3006 20.8, which is the current year which X was using the asset. The year which X was using the asset. So on that year which X was using the asset, the depreciation will be the 2,800 times the 20%, because they told us that the depreciation is on 20%, times the 20%, then multiply by the months which the asset was used, 1 January to June is 6/12. Now we get the depreciation on profit of 2,800 times 0.20, then times 6 divided by 12. Now it tells us that the depreciation of the profit realized, it will be 280. Then the 280 now should be added on our retained earnings because it affected the, when they were realizing it. When we realize that profit is now becoming our income because we deduct it because it was unrealized, but now because we used the asset, now we're gonna realize it as an income. So an income is gonna affect the profit, then the profit is gonna affect the retained earnings. Now you're gonna add the 280 here. So it means now the retained earnings on our books, it will be sitting as 480. Are we clear up to here, up to so far? The purpose of adding the purpose of the 200 and adding the 280 part. Glenn? Tandega?
It's clear, Mr. Wala.
And then Mulise?
Yeah, it's clear on myself.
Okay. Then we continue further. We have the 480, then we're gonna do our percentage based on the 75%. Then it will be the 360, and then we have the 120 as the difference. Then we're gonna have the current year. So the current year will be the yellow part. Current year. On the current year, there was no asset sold because the asset was since sold in the prior year. So on the current date, we'll only focus on the profit. We've got on the Y limited, we have 10,000 as our gross profit. We less the 2,000 depreciation, we have 8,000. We less the tax expense, we have the profit of 6,000. So it's gonna have a profit 1,000. Then we have to add the realization of the depreciation. So the realization of the depreciation, it will be based on the current year, which it was now used from 1 July 2008 to the 30 June 2000. 1 July 2008 to the 30 June 2006 is the full year. So X used the assets. So since the X used the assets, he now realized the profit from that asset which was purchased from Y. So we're gonna add the 560. So the 560 comes from the full depreciation as a result of the 280. 2,800 times the 20%. Because it was now used for the whole year, which is gonna give us the 560. So this 560 is now added here. But that side we added 280 because the 280 was only the 6 months part that was used from the since acquisition to the beginning of the current year. The 6 months of from 1 July, from 1 January 2006 up to the 30/06/2006. But the 560 comes from the period it was used from the 1 July 2006 up to the 30/06/2007. So we realized on the year it was used, which it was last year, because the current year, the yellow one, the realization part will be recognized in the next financial year. So when we realize using the backwards method, like whatever it happened this year will be realized next year, and then whatever happened last year will be realized in the current year. So the 560 comes from the portion of 1 July 2006 up to 30/06/2007. And then we go further. Then here it means it will be the 6,560 as our total. 6,560, and then our since acquisition as based on our percentage method, it will be the 4920. And then the difference, it will be the 1640. Then that's how our analysis it got affected. So this is based on the profit realized in the current year and the 560 of the depreciation on profit realized in the prior year. So the 560 here was realized in the prior year. Realized on the prior year, which that prior year, it was the period between 1 20.6 to 30.06, 20.7 was the one of 0.7 to, okay, let me focus on them financially again. 107.28, 2.822 is the current, and then the prior year it will be 107, 2007 to 30 June 2008. Okay, here's should be 07 to 30 June 8. So that's what we are realizing here. The reason for this 560. Then we can go further. We do our, on the pre-adjustment, the pro forma consolidated journals, the share capital on the page 148, the share capital part is, we all know how to get there. The retained earnings of the 2.8 is based on the intercompany profit that we have realized, the one for 2,800, it needs to be eliminated. So in order to eliminate it, you have to do the journal for individual book of the entries of each company, whereby you sell the machinery, then you get a bank, and then on the other side, he get the profit, and then it get reduced by the machinery self, and then the one which the contra account, you're gonna eliminate them, so it will be the machinery and the retained earnings, because the profit will affect the retained earnings, and then on the other side there's a deduction of the machinery from the book of X. Then the accumulated depreciation part, the depreciation of Y Limited being the 560 is a depreciation he realized during the current year. The 560 comes from the current year usage of the asset, and then the retained earnings is based on the 280, the one which we did before, of the realization of the prior year on the date, from the date he acquired the asset up to the 30 June 2006. 30 June 2008. And then from there, we have the, when we add the 560 and the 280, they will give us the 840. And then the 120 comes from the NCI as based on the since acquisition to the beginning of the current year, the retained earnings part. That one we know how to tackle it. And then the NCI, we also know how to take it because it comes from the 1640 of the current year basis of the profit realized from the subsidiary point of view. Then when we go to our consolidations, we're going to start with the statement of profit and loss. So the gross profit, the 20,000 plus 10,000 is the one from the face value of the pre-adjustment trial balance, which it was the gross profit of 20 plus the one for 10 of a subsidiary. And then administrative expenses. So our admin, it's going to be our depreciations, the 3,000 plus the 2,000. Then we less the 560. The 560 is the current year depreciation that was done from the usage of the asset, because it's the depreciation part. It needs to be deducted yet because it's not yet realized. It will be realized in the following year. And then we have the income tax, which is just straightforward from the 5,000 and the 2,000. And then we calculate our profit, which will be the 18,560. So this 18,560, it will be added to the, it's gonna affect somewhere, somehow, our, we're gonna check the one which is owing to the parent so that we can able to do our NCI. Then we go to the statement of the financial position. On the machinery point of view, we have the 14,000 and the 20,000, which are the cost of the assets. Then we less the 2,800, which is the profit realized. Then the minus accumulated depreciations. So the accumulated depreciation will be the 6,000 from the X and the 4,000 from the Y, and then they minus the 840. The 840 comes as the accumulated depreciation based on what happened in the last 18 months, which will be the first 6 months from the way the asset was purchased, and the next 12 months from based on the current year, which it will be the period of the up to the 30 June 2009. From 1 July 2008 up to 30 June 2009 will be the 560, and then from the 1 January 2008 up to 30 June 2008 will be the 6 months, which it will be represented by the 280. So the 280 plus the 560, they will give you the 840. So that is the accumulated depreciation, which must be deducted from our total accumulated depreciation of the group, as shown in page 148 calculation at the top. They show the calculation for the depreciation. That's where you're gonna end up arriving on this 840. Then the current asset is just straightforward, and then the share capital will be the one of the parent because the subsidiary part is eliminated. The retained earnings, it will be based on, when you check your retained earnings from the SCE, you have the balance of 18,360, which came as a result of the 18,000 plus the 360 from our group on the 75%, and then we have the total of the 18,360. Then you add with the current year profit from our SPL, the one going to the owner's equity of the parent, which is 16,920. Then we arrive to the 35,280. So that 35,280 from the retained earnings on the SCE, we transfer it to our retained earnings on our balance sheet. Then we add it to the share capital. Then we arrive at the 85,280. So that's how the treatment of the situation where subsidiary is selling a depreciable item to the asset, to the parent. So the main impact will be more on the analysis of the shareholders, since we are dealing with the analysis of the shareholders of the subsidiary. So we need to show how did that profit affect his current year and how did it affect the prior year, depending if the asset was sold was acquired or was sold by the subsidiary in the prior year. So if it was sold by the subsidiary in the prior year, the profit will be deducted in the prior year part, and then the depreciation realized in that prior year will be added to the profit, which is going to affect the retained earnings. And then the profit or the depreciation realized during the current year now will be added on the current year financial year. Is there anyone who have a question before we go to one of the exercises? Any question? So you must note these summaries that I've done with regard to the selling of a depreciable asset to parent by the subsidiary when the subsidiary is selling a depreciable item. Anyone who have a question? Okay, silent means everything is fine. Then we've got an exercise on page 149, exercise where we're gonna have to learn what was the matters here. And then I think it can last us for an hour. Then next week we'll do another exercise, because on the first exercise, they are looking for the consolidated financial statement, which will be the balance sheet, the income statement, and the statement of change in equity. However, on the next example, example 2, they were only looking part of the statement of profit and loss. Okay, let's see. Question 1, page 149. We've got the abridged trial balance of A Limited and B Limited. And then from there, we've got the adjustment. They say A Limited acquired its interest in B Limited on 1 July 2005, on which date B Limited retained earnings was 72,000. At the date of acquisition, A Limited valued the land and the building belongs to B Limited, which had a carrying amount of 308,200 and at 368,200. So it means the carry amount is 308,200, but just revalued to 368,200. It's a company policy to revalue B Limited land and building every 2 years at 30 June. B Limited has not purchased or sold any land or building since 1 July 2005. Consider the carrying amount of all the other assets and liabilities of B Limited to be equal to the fair value thereof at the date of acquisition. Then A Limited discounted 2,000 of the bills receivable from B Limited at the bank before the expiry date of 6 July 2008. Since A Limited acquired its interest in B Limited, A Limited purchased all its inventories from B Limited. So in this case, B is the one selling the inventories to A. So subsidiary is selling the inventory to the parent, and they sell it at the cost price, 25% profit. So the inventory on hand of A Limited and B Limited amount to 36 and 48 respectively on 1 July 2007. So the balances on 1 July 2007 will be our opening balances, and then we're gonna have the closing balances as given from the average trial balance. And then the last adjustment, you say on 29 June 2008, B Limited repaid 5,000 of the existing loan from A Limited. A Limited received this repayment on 3 July. Then draft the consolidated statement of financial position of A Limited Group as at 30 June 2008 in accordance with IFRS, and then you ignore the taxation on the unrealized profit and losses. So in this case, our assumption is that they need everything. So let's draft our analysis of shareholders. So exercise 1. Or I can say question 1. Question 1. Page 149. Then we're gonna first draft our analysis of shareholders. So it will be the edge. And then we have the at NCI. And on the date of acquisition, we had the share capital. The share capital of B Limited was represented as 200,000 from the average trial balance. And then because he issued 100,000 shares and this guy acquired 70,000. So it means the interest here, it will be sitting at 70%. Sorry, here should be total. Total. And then the the 200,000, and then at 70%. So the 200 and the 70% part, it will be the 140. And then we don't have anything here. Then we're gonna have the difference of, we have the difference of 60. Then the retained earnings as given on the date of acquisition. Retained earnings on the date of acquisition, it was given as 72,000 from adjustment number 1. 72,000, and then the 70% part of it will be 50,400, and then the difference will be the 21,600. Then we have a revaluation on the date of acquisition, because they told us as adjustment number 2. Revaluation revaluation the revaluation, it was initially it was sitting at 308 carrying amount, and then it was now revalued at 368,200. So we'll say the 368,200 minus 308,200, then it gives us the total revaluation of 60,000, and then we say times the 70%, which will be the 42,000, and then the difference will be the 18,000. Then our guy purchased this at the cost price of 290, as shown in our bridge triangle balance. They said the investment in B Limited is 290. So we're gonna do the total of this to see how much do we have. Then we add all this together. Which will be the 140 plus the 5,400 plus the thing, 42. They give us the 232,400. And then he paid consideration of paid by our parent. Our parent paid in a consideration of 290. There was a gesture that our parent did. So as a result of that gesture, so it means he have a goodwill. So our goodwill will be the difference between the 290 and the 232, which will represent by the 57,600. Then we go further. We're gonna have our at acquisition. We're gonna have the since acquisition. So question we have to check since acquisition to the beginning of the current year, since acquisition to the end of current year. The acquisition was made on 1 July 2005. So 1 July 2005, and then the next proceedings will be from the 2 July 2005 to 30 June 2006, 2007, and then 2008. So the second 202, 07, 20.5, up to the 30, 06, 20.7 will fall under since acquisition to beginning of current year. And then the period 107 20.7 to 30.06 20.8 will fall under the current year. Now let's tackle the portion of since acquisition. So the since acquisition, since date, they did a revaluation of the 368,200. So now revaluation. It was carrying amount initially. Let me do this. Treatment of the revaluation. So on the date of acquisition, at acquisition, the cost of the asset, was sitting on 308, or the carrying amount. Let's say the carrying amount CA of asset was sitting on 308,200. Then now on 1 July, they revalued and is sitting on 368. 107 20.5. Now, as a result of the revaluation, now the asset is sitting on 368. There is a revaluation surplus here. Of 60. Now, the next revaluation it should be on, because they say they revalue on every 2 years. The next revaluation is gonna happen on 1 July 2007, because it will be 1 July 2005 to 2006, then 2006 to 2007. So the next revaluation part will be on 107 2007, which now, and then the next one will be on 107 20.9, and this is the year which we don't have on our side. So it means since our financial year is up to 30 June 30/06 20.9, so whatever value that is sitting here, which now is sitting on XXXX, it will be the same value that is sitting here. So based on the information we are given here, we were told that on the 30 June, on the 30 June 2008, here should be 2008. On 30 June 2008, the value of the asset, or the value of this land and building, is sitting on 408,200, the one for B. So here is sitting on 408,200. So it means our revaluation will be this less this. So our revaluation, because the value that is sitting on 30/06/2008, it will be the ones going further to the 107/2007. So it means our revaluation, when it was done on 107/2007, it was also 40/08 here. Because from 1 July 2007 to 30 June 2008, there was no revaluation. So the revaluation here is nil because it was not yet 2 years. Revaluation is nil. The reason being is not yet 2 years. Not yet 2 years. And so it means we're going to only focus on the revaluation at since acquisition up to the beginning of the current year, because our beginning of the current year is here. So from here to here, there was no revaluation. So it means nothing will go to the current year as a revaluation. Instead, our revaluation is going to be on our since acquisition, which is the date here, up to the beginning of the current year. So the beginning of the current year is 107, 2007. So our revaluation surplus is going to be it will be the 408 minus the 368. 408 minus the 368. So it means our revaluation surplus will be sitting as 40,000. So this 40,000, since it's for the since acquisition to the beginning of the current year, it must come here. Because on the current year is nil. We don't have anything here. So this value, it must affect our since acquisition to the beginning of the current year.
Sorry, where do we get the 40,000?
Yes, I will show you now. So the 40,000, the one for the revaluation, it comes as a result of we had the carrying amount of 308, right? And then we made a revaluation on 1 July 2005, which is sitting on 368,200. Are you fine there?
Sorry, yeah. Yes, I was muted.
Okay. Then they told us that the revaluation is happening every 2 years. So we did the revaluation on 1 July 2005. So it means that our next revaluation after this date, it will be on 1 July 2007.
Yeah.
It will be 2 years. So after the 2 years, our next revaluation must be when? Must be on 1 July 2009. Okay. So the one for 2009, since our financial year is not even reaching there, so this one we don't gonna focus on it at all. This is outdated. It's out. Just leave it. Now, we were told that as at 30 June 2008, which is our financial year, this is our fin year. As at 30 June 2008, our land and building is sitting on 408,200. Do you see it from our pre-adjustment trial balance? The one for B Limited. So as at 30 June 2007.
Oh, okay.
Yeah, it's sitting on 48200. So now since it's sitting on 48200, so we assume that this balance of 48200, it was the same balance on 1 July 2007 when the revaluation was done, the actual one. So it means you're gonna say the 48200 minus the previous revaluation, which was done, is 368,200. So this 368, the difference between the 368 and the 408 will be the 40,000, and this 40,000 will fall under since acquisition to the beginning of the current year, because it was done in the prior year, not on the current year. Because on the current year, there was no revaluation to be done yet.
Okay, makes sense.
Okay. So on our since acquisition to the beginning of the current year, so here it will be to BGN of current year. We have a revaluation, which will come as the result of the 408,200 less 368,200. So our revaluation will be 40,000. So we do our percentages on the since. Oh, sorry. Let me add some columns so that we can be on the same page. This should be 40,000 here. And then here it will be dash. Then on our since acquisition, so on our since acquisition, we're gonna have the 70% of our 40,000, which it will be the 28,000. And then the difference will be the 12,000. Now we are done with this part. Now we must come to the current year. Was our asset was purchased, or the inventory part. The inventory on adjustment number 3 is discount bills, which was happened on 6 July 2008, which will be our discount bill 2000 of the bills received from bills at the bank before the expiry date. Okay, this just happened. The current year is fine. And then since A Limited, adjustment number 4, since A Limited acquired its interest in B Limited and A Limited purchased all its inventory from B Limited, B Limited supplies the inventory at a cost plus 25% profit, and the inventories on hand of A Limited and B Limited amount to 36 and 48 respectively on 1 July. So those are the opening balances. So since it's on the opening balance, on the opening balances, it will be realized profit. But on the closing balance, it will be unrealized profit. So the realized profit are added, the unrealized profit are subtracted. So now we're gonna go to the current year. So we must have the retained earnings at the beginning of the year based on the current year. On the current year, we had the retained earnings of let's see, our retained earnings is now on the B Limited is sitting on 137,600. However, they didn't say this is retained earnings at the beginning. Instead, it's given as the retained earnings at the end. So by doing that, we are also forced that we must show our since acquisition up to the end of the year, because now we forced by the situation of the retained earnings. They didn't give us the retained earnings in the beginning. Instead, the retained earnings is sitting at the end. So it means our since acquisition now it must change. Instead of to the beginning of the current year, now it must be to the end of current year due to the retained earnings balances not given at the beginning of the year. I don't know if I make sense there. So now our since acquisition to the end of the current year, it will be the revaluation which we done. Now we must go to the retained earnings. And remember, the retained earnings at the end. The retained earnings at the end, it will have the profit, it will have the and it will have the realized profit. So the balance as given on the retained earnings, the given figure or the balance sitting as we're given the balance of 137,600. So we're gonna put the 137,600 here as our calculation. So it's 137. Now there was a profit of the unrealized profit. The unrealized profit is based on the closing balances. So unrealized profit, since the subsidiary was the one selling, unrealized profit based on closing balance. So the unrealized profit based closing balance, the closing balance of the inventory on the subsidiary was how much? Especially the one for the parent, because subsidiary was the one selling to the parent here. So it means subsidiary in the profit. So the closing inventory of A Limited was how much? It was shown as 45,000. The closing inventory of A Limited. So it will be the 45,000 times 25 divided by 125. So it will be the 45,000 of the closing inventory of parent, because subsidiary was selling to the parent. So it means subsidiary is the one realized the profit. But because the parent had not yet sold the inventory to public, it's still unrealized. So it will be the 45,000 multiplied by 25 divided by 125, which is 9,000. So this 9,000 need to be deducted. The reason being is unrealized. It's not yet realized because A Limited didn't sell it to the public yet. Now, we're gonna go to the retained earnings at acquisition. Okay, let me put some. The retained earnings at acquisition, because normally, suppose we were doing the retained earnings up to the beginning of current year, we were gonna say retained earnings as the balance shown in the beginning of the year, less the retained earnings at acquisition. Normally we do that, right? I need the response.
Yes, we're listening.
Okay,
Yeah.
so since in this case, because we are not dealing with the retained earnings up to the end, up to the beginning, we're gonna just take the retained earnings as the balance, and then we're gonna subtract it, because we're gonna subtract from the 137. It's like when we say the retained earnings is 137,600, then minus our 72,000 is still the same. Then it will give the positive figure of how much? 137,600 minus 72,000. It will give the 65,600. So it's either we show the 137,600 here in the column, and then we put the retained earnings at acquisition as 72,000 in the negative part. So the retained earnings, retained earning at acquisition. The retained earnings at acquisition was sitting at 72,000, which need to be subtracted. And then now we're gonna have the realized profit. The realized profit, it is based on the opening inventory so on the opening inventory, the opening inventory of A Limited, which means this inventory is now sold to the public. The opening inventory of A Limited, it was shown as 36,000 from the pre-adjustment trial balance. I mean, from the adjustment number 4. So it's 36,000 multiplied by 25 divided by 125. So is because it's now realized. And when it's realized, it needs to be added back. So we add it back as 7,200. Now, 86,000 times 25 divided by 125, 7,200. So This is now realized in the current year. However, remember when you were doing the retain any, because this inventory was sold on, let's see, since AIM acquired interest in A Limited, purchased all its inventory from B Limited, and then this was balances on 1 July 2007. So the balance on 1 July 2007 of the inventory, it was the closing balance on 30 June 2006. You remember, right? Respond, please.
Yes, yes, yes.
So remember when we were tackling the profit of that year on the profit on 30 June 2007, this balance, it was sitting as unrealized profit. And since it was unrealized profit, it affected the retained earnings of that time. So now you have to show it here because it affected as a minus in that time, but now it's going to affect as a plus on the current year. So you need to show it here as an, this was the unrealized profit based on closing inventory. Yeah, the one for inventory on 30 June 2007. So here was the on the balance of 30 June 2007. Inventory on 30/06/20.7. So it was a closing inventory on 30/06/2007. It was deducted. Now it becoming the opening inventory on the 2008. Now you realize it must be added back. So here it was minus the 7,200 because here it was sitting on the closing, but now it became the opening is realized. So now on this inventory part, this one is a closing is minus. So it means suppose we are doing the 2020, suppose we're doing the 2029 financial year. Now this 9,000 on the retained earnings, it was going to be added back. So I guess you understand this thing that is being done here. Why are we adding and subtracting million times? I guess you understand this thing. So now we go to our end balance. We want to now determine how is the balance of our retained earnings as at the end of the financial year. So our balances, it's gonna be based on this. We're gonna circle them all together. So we're gonna add all this together. 137,600 minus 7.2 minus 9,000 plus 7.2 minus 7.2. Then they give us the value of 56,600. So it means this is the retained earnings at the end of the year, whereby whatever percentage that we're going to calculate here, it will affect the retained earnings in the statement of changes in equity. Because it will be the one of the parent, which it will be the 213 plus whatever percentage that we're going to calculate here. Because this is the retained earnings at the end of the year. So the retained earnings at end. So the 56,600 you times by the 70%. It gives us the 39,620. 39,620. Then the difference will be then 16,980. Then this is done. So this is gonna affect our retained earnings on our statement of changes in equity. This it will be our RE. So now we can do we can add whatever need to be added. So this was the calculation from my side. So it means our retained earnings, it will be sit on 56,600. So we can add everything. So here we have a 486,200. Here we have a 28,000. Which we can add them all together, both of them. 28 plus 39,620. So the total here was supposed to be the 67,620. And then here we have a total of 128,580. Then when we do our pro forma journals, and I'm not gonna dwell more on it because I'm also checking the time. So we have a loan. Let's say on 29 June 2008, B Limited, which is the subsidiary, repaid the 5,000 of the existing loan from A Limited. However, A Limited received this repayment on 3 July, so the payment is still coming. So now it must be eliminated in the books. So the pro forma journals for elimination. Pro forma journals. So as I told you, the trick of doing the journals, you must at least start doing the journal by your own as if it's in the book of one person. So let's do the journal of A Limited alone and the B Limited. On A Limited, who is paying who? Let's see. On 29 June, B Limited repaid. So B is the one repaying. So it means A is the one receiving. So A will be, because he's not yet received this, is still coming on his side. He's gonna have his loan, the loan to B will be reduced, and then the trade payables will also be reduced. So his trade payables, so we're gonna have DR and CR, DR, and then the CR. So it will be the loan, which the loan will be reduced. On the debit side, it will be the loan because it's the reduction of the loan or the unsecured loan of how much? It will be reduced by the 5,000. And then the reason they're reducing it, it can be the loan, it can be trade payables, either or. Slash trade payables. Remember, normally the trade payables, they increase on the credit side. But in this case, because we are reducing them, they will be on the debit side. And then the effect of the transaction, it will be in the form of, because he paid cash. So the bank of 5,000, bank, the 5,000. And then in the books of B Limited, in the books of B Limited, he will have on the debit and the credit also. B Limited is the one who paid. Let's see who receiving what. On 29 June, B Limited repaid 5,000 of the existing loan from A Limited, and A Limited received this repayment on 3 July. Okay, this journal should be the one. This journal should be the B Limited. Sorry, should be B Limited. And then we've got a journal of A Limited. So A Limited will be receiving a bank with an increase of 5,000. And then his receivable will be decreasing. Then the contra account of this will be the unsecured loan versus the cash. So when we reverse them, it will be our cash in transit is that we as the group, we have to receive an amount of 5,000, and then the loan that we made to be limited, because it's not yet paid, it's still, the cash is still coming. So it means our loan, we still have to increase it back further back by the 5,000. So the journals, for elimination purposes, it will be cash in transit, which is the bank side. It increased by the 5,000. And then the loan is not yet paid because it will be recorded in the following year, because when we are closing the book, the loan is not yet paid. However, the cash is paid. The cash is paid, but it's not yet received on the other side. So it means the loan is still standing. So the loan will be on the credit side because it still remains, it's not yet reduced at 5,000. I don't know if it makes sense, this. Confirmation? Please say.
It makes sense.
Yeah, just thinking. So you sent the 5,000. We put it as is. It's
The 5,000.
yeah.
Repeat your question. I didn't get some of the words because I think there was a little bit network.
Okay, so the 5,000. Oh, okay, because that was the money that was paid from A to B.
Yes.
Oh, okay.
But
Okay,
however, it's not yet received because he paid, but it's still gonna be recorded in the books on the 3rd. They said 3rd of July.
3rd of July.
On the fine, so it means on the other side, the loan is not yet reduced. It's still, because the reason we do this because he told us that he paid 5,000, so it needs to be cleared. But suppose he didn't tell me, so it means on my side I will say the loan is still standing as 5,000.
Okay.
Yeah.
Okay. Fine. Thanks.
Okay, and then we proceed further, whereby I'm gonna only do the elimination journal, the one which they're tricky, the one like the share capital is normal. We know how to deal with this. I'm not going to tackle them. The revaluation of the 12,000, we know where it came from. It came as a result of the since acquisition to the end of the current year, the 12,000 from the NCI, the 16,980. You also know it comes from the NCI retained earnings up to the end of the current year. Then the bills payable. Now, when you go to adjustment number 3, they say A Limited discount 2,000 of the bills receivable from B Limited at the bank before the expiry date on 6 July. But when you check on the bills payable from the pre-adjustment trial balance, we've got bills to be paid by B Limited, which is 10,000. So 10,000 was supposed to be paid to A. However, there was a discount made of 8,000, of 2,000. So it means the 2,000 is the discounted, it's written off. So the bills to be receivable is 8,000. So when you do the pro forma journals again, there will be bills payable on the bills receivable. It's gonna be on the debit side, and then it must be reduced by the bills. And then on the other side, it will be bills on the expense on the debit side, and then the bills payable on the credit side. So when you reverse the two, then it's where you're gonna end up having the bills payable by B Limited 8,000 and the bills receivable by A Limited 8,000. So individual journals will be like this: the individual journals of A Ltd. So A will be receiving the bills. So A Limited will be receiving the bills. So in his book, it will be on the debit side. It will be bills receivable because as the asset. So it will be the receivable because normally the receivable is the asset, the increase on the debit side because he's gonna receive that 8,000. And then the contra account it will be the bills. The 8,000. And then on the B Limited, we'll have because he's still gonna do the expenses. So his expense they need to increase, which will be the bills, because the bills will represent the expense that he need to pay. And then it will be the bills payable here. It will be the payables because you still have the expenses to pay of 8,000. Then when you reverse this, so it means this to be reversed. So as this. So it means it will be the bills receivable on the credit side of A Limited, and then the bills payable on the debit side for B Limited. So when you do the journal, it will be bills payable, the 8,000, and the bills receivable. Receivable. So here it will be B. Here's A Limited. And then this side will be B Limited. Then when we go further, we'll have the elimination of the profit. So this was based on the unrealized one. On the unrealized is based on the closing inventory. The closing inventory, as we were told, it was sitting on the 45,000. So the 45,000 times 25 divided by 125. The 9,000, so it's gonna be deducted. So it will be the gross profit because they're gonna decrease the gross profit. The gross profit will be decreased by 9,000, and the inventories will also be decreased by 9,000. And then the 7.2 is based on the one which is realized. So our retained earnings, normally the retained earnings increase on the credit side. So the retained earnings increment will be increased by 7.2. However, since we are eliminating it, so we have to debit our retained earnings and we credit our gross profit. And then the long-term borrowings. So we have a long-term borrowings because it was an amount given of how much? 35,000. So the loans between the two companies must be deducted, all of them. So it means we are writing them off because it was the loan from A. If you can check on the B Limited, on the A Limited, they said the unsecured loan at fair value was 40,000. However, on the long-term borrowings, they said is 35. The reason is because they took out that 5,000 payment, the 5,000 payment, which was shown on adjustment number 29, whereby they showed on 29, adjustment number 5, whereby they showed on 29 June 2008, B Limited repaid 5,000. So since B, he got the loan of 40,000, but he paid the 5,000, so it means the balance remaining is 35. So now we write off everything. We debit our loan. We debit our long-term borrowing of 35,000 from A Limited, and the unsecured loan for B Limited is also 35,000. So we cancel each other. So any question with regard to the pro forma journal thingy?
Hi, Mr. Molepo. So my question is on the bills payable, right? Shouldn't the 2,000, which is the discount, be eliminated here in the journal as well?
The discount, no. The discount as elimination part, it's gonna form part of the expense. It will be shown somewhere where you're gonna show the 2,000 because it's the amount which was supposed to be included, but he decided to write it off. So when he write it off, it will be the expenses on the A side.
Only, okay.
Yeah. So you're still gonna show it. You will see it. It will be reflected as an expense of 2,000. If you check, hold on. If you're gonna check your current liabilities, you see now they say the trade and other payables is 41 plus 60 plus, they say 10,000 minus 8. So in that 10,000 minus 8, they are trying to write off that 2,000.
Oh, okay. All right. Yeah. I thought it would have shown on the journal as well. All right. Thank you.
All right. Okay, then let's proceed further. We're gonna go to, in this case, since we are not given anything to do with the statement of profit and loss, so it's jumped because I don't see any nothing to do with the profit here. So that's why they didn't draft any statement of profit and loss. So we're gonna jump further to the statement of financial position, whereby on the pro PE, we have 574 plus the 408. Those one are the balances as shown from the pre-adjustment trial balance of the properties. PPE 574 and 408 as given at raw as is, then plus the 155 plus 97. The 155 represented by let's wait somewhere, just hold on. The 155 is the motor vehicle. The motor vehicle of 155 plus the another motor vehicle of 97,000 for B Limited. We add them because we are doing the PPE. Then we less the accumulated depreciation as shown on your credit side of the balance sheet. The second bottom line, we've got accumulated depreciation of 130 for A Limited and 64,000 for B Limited. Then we less them all together because that's the accumulated depreciation. And then we have a goodwill of 57,600 as calculated from our analysis of shareholders. Then we are done there. Then we go to the inventories. Our inventories is sitting on 45,000 for the one for closing balance of A Limited as shown on the debit side of our balance sheet. And then we add it with the 72,000 as shown on the balance sheet for B Limited. Then we less the profit. The profit will be on the unrealized profit. As per my summary, which I shown last week, I think you can see this my Excel there, where subsidiary is selling inventory to the parent on the inventory side. The unrealized profit will affect the face value of the SFP here. So in this case, since it's unrealized, it will be deducted. So let me write here, it will be deducted. And then if it's realized, it will be added. The same here, it will be deducted. And then we deduct the unrealized profit of 9,000, which because it's based on the closing inventory. Next year, after the inventory was sold to the public, is when now it's going to be realized. Then we're going to add it back. Then trade in other receivables is 86,200 plus 19,400, which is fine, that one. And then it's just straight from the subsidiary and the parent. The cash and cash equivalents of 10,660. It comes from the bank of the subsidiary, B Limited, because A was having an overdraft. Then we have the equity and the liabilities. The share capital is the one of the parent because the subsidiary is eliminated. Other components of the equity, the 28,000. There's other components of the equity. It will come as a result of the revaluation. Let's see, 100 con. It will come as a result of the revaluation. The revaluation which was done from the analysis of shareholders. If you remember, we have our revaluation here. So this, it will be our OC because we take our percentage was the OC up to the end of the current year, then we're going to add the 28,000. So it will be the other components of the equity, which will be the OCE or the OCI. And then the retained earnings. The retained earnings will be the 213 from the pre-adjustment trial balance plus this one, the 39,620 as calculated, because this was the retained earnings up to the end of the year. And then we have the non-controlling interest, which would be the one calculated of the 128,850 is based on the total down there. It's based on this. And then we have the trade and other payables. Now is the one which Tandeka was asking. We had the balance of 41,000 is from the book of trade and other payables. 41,000 from A Limited, and then plus the 60,000 of B Limited, 6,600, I mean, of B Limited. Then plus on the 10,000, they say this is the 10,000 of the bills that was supposed to be received as shown on the bills payables. Remember, on the B Limited is bills payables, but at the end, it's going to be the bills receivable by the A Limited. So out of the 10,000 of the bills payable, we less the 8,000. The 8,000 is the one received because there was a discount of 2,000. So we less the 8,000 of the one received. So it means the 2,000 of the discount is the one which need to be added on our current liabilities, because at the ends need to be paid from the outside of the public. It's no longer going to be within, because he declared the bills of 10,000, but he gives the discount of 2,000, and then I pay the 8,000 back to him. So the 2,000, it means he need to get it from outside. So since we are the group, so that 2,000 must be get from the outside of the public as our trade and other payables. So it means we have to raise our trade. We have to make a provision of our trade and other payables to 2,000 as an increment. Tandeka, are you sorted now?
Yes, sorted. Thank you, Mr. Miller.
Okay. Then we had a big overdraft of 14.2. So since our A, he had a bank overdraft of 14,200 as shown in our pre-adjustment trial and balance. And remember, he's gonna receive 5,000 as an increment. He's gonna receive he received a 5,000 from B Limited. So it means in his bank, the bank overdraft is now decreasing. It's no longer sitting on 14,500. It must now decrease because of the 5,000 he received from B Limited. So it means now his bank overdraft is being reduced by the 5,000, which now his bank overdraft will sit on the amount of 9,200. I hope it also makes sense there. Because when I open my books, I have a bank overdraft of 14,200, but someone deposited money into my account. So it means my bank overdraft is no longer sitting on 14.2. It's going to be reduced by the amount which was deposited into my account. So at the end of my month, I recorded the bank overdraft of 9,200 as a result of the reduction of the cash deposited into my account before the month end. I guess it also makes sense there. So that is the end of this exercise 1. So the next one, it will be the exercise 2, which will be the last one for the topic 7. But that one is the situation of, suppose now they are asking the statement of profit and loss. How do you tackle that? So based on the summaries I did, which it will be this summary, and the previous summaries I did on the last week. If you follow these summaries, then you can be in the good condition to ask, not to ask, to answer a questions based on the consolidations whereby the assets are being sold towards each other, whether the assets are being sold to the subsidiary selling to the parent, inventory being sold to the subsidiary or being sold to the parent, or the depreciable assets. Because you're gonna just follow the summary whereby say it affects the face value of the statement of profit and loss, you deduct. It affects the face value of the SPL, you deduct or you add. So you just have to check, is this unrealized profit or realized profit? Unrealized profit, you deduct. Realized profit, you add. So the realized profit will be based on the next year. So if it happened last year, so on the following year, it's gonna be realized. The same applies to the depreciable asset. If they sold the depreciable asset on the current year, it will be the unrealized profit. It will be deducted. However, the depreciation, it will be added in the next year as that asset will be used by the subsidiary or by that particular parent, depending on who sold to who. So if you can just follow the summaries that I made, then you can be on the good condition to answer the question on the situation whereby the group, they have the intercompany or the intra-group transactions. Anyone who have a question with regard to where we are right now? Suppose you have a question, you can also post it into the group. I think I can able to reply it from the group side of view. Anyone who have a question?
Look, for now, I'm fine. I'll ask questions on the group if I have during the week.
Okay.
No question on my side as well.
Okay. Glen Rose, you can, if your mic is working, you can talk. If it's not, then you can type so that we can be on the same page. If you are talking, I can't hear you, so it means your mic is not working. Okay, cool. We will meet again next week. So next week, do you want us to treat the question 2, or you want us to treat the learning unit number 8, the dividends part? You tell me.
Okay, just
I think if we just go ahead. Oh, sorry.
Yeah, if you don't mind, I'm thinking if we do the question 2 again, just
Okay.
to make sure, and then
All right.
we can.
Okay, so it means I think the first hour will be question 2, and then after question 2, another hour will be devoted to the declaration of dividends. But if you can master that unit 7, then you will be in the very good chance of passing the exam. Because now, based on whatever we're gonna do now, it's gonna be replication of what we did on study unit number 7, so that they just want to test if you can able to understand it. Even though we'll be doing study unit number 8, they will put the information of study unit number 7. Again, when we'll be doing study unit number 9, they're gonna put the information of study unit number 7 and 8 and 9. Then it means by that point now you'll be understanding the intra-group transactions. And then did you notice the preliminary dates?
Yes, the 26th of October.
Yeah, let's hope it doesn't change. And then if it doesn't change, then it will give us we'll have a good to treat this module until the exam, because I think we still have enough hours, because we are given hours to tackle the module, but up to so far, we still have enough hours. As long as the exam will remain the 26th, then we can be able to reach our self-evaluation exercises, the one on the tutorial letter 102. We can do a couple of them. So let's keep our thumbs crossed so that the date doesn't change.
Okay.
Cool. I'm done from my side. Anyone who have a question, we can also post it into the group. Then it will be attended. Glen Rose, and I don't know if you are in the group. Let me check. Sure. Yeah, you are in the group also. Yeah, thanks very much. Keep yourself safe and be warm, and then we'll meet again next week.
Thank you.
Thank you.
Thank you.
Thank you. Bye.
Bye.